Hey everyone, John Henry here with School of Trade, and today we're going to be taking a look at market structure. Now, market structure is a lot of different things, but in generalization, there's four main market structures that you want to be paying attention to. So starting from the top, the first one's going to be a bearish channel. Now, a bearish channel is going to be consistent of lower highs, lower lows, essentially moving down. And that's what we're seeing right here in this example. And the big thing about this is going to be you're going to want to trade it by selling the highs. When you're looking at a downward trend, you don't want to be selling down here, right? That doesn't make any sense. You're not going to make any money. You're going to be giving all the money back to the market. You want to be looking to sell when you reach those highs, like here, even here or here. That's kind of the idea that you want to be looking for in a bearish channel. So that's going to be the first one. It's just essentially a downward trend. The next one's going to be a bullish channel or an uptrend, and that's going to be consistent of making higher highs, higher lows. That's also significant as to the green channel indicator that we're using, and if you saw on the other one, the red one as well. And the way that you're going to trade this is just buying the lows. Again, just like we saw in the previous example, you don't want to be buying at the highs. That doesn't make any sense. You're not going to make any money that way. You want to wait for price to come down to where it's cheap. If you know you're already in a bullish channel in the trend line or the channel indicator is green, then just look to buy the lows, especially if you get all the way down to them. Those are going to be the areas that you're going to be interested in buying at the lows. Now, the next one's going to be consolidation. Consolidation is kind of one of those harder market conditions to trade if you're used to trend trading, but it's consistent of higher lows, lower highs. It looks like a wedge, and that's this example right here. So when you see price sort of narrowing down and getting tighter and tighter and tighter, that's going to be the area that you're going to want to look to buy the lows as well as sell the highs. This is the one that you're able to look and take both sides of the trade. So when you start coming into the highs right here, look to sell it. When you start coming into the lows, that's where you start to look to buy those lows. So it gives you an opportunity on both sides that you can hop on board with. Now, wedges can be a little bit more difficult in a sense because the tighter and tighter and tighter they get, the more likely you are of not going to sell the high, but to break through. So you have to use caution in those areas. But that's the biggest way to trade these types of wedges is just selling the highs, buying the lows. Now, the final one is going to be just a complete sideways range. And sideways ranges are really easy to see. They just look completely flat. You got double tops, double bottoms, red or green channel indicator, but you'll notice the channel indicator itself is completely flat. It's not going anywhere. It's not doing a whole lot of anything, and anytime it comes up to those highs, it falls down. If it comes to the lows, it comes up. Well, it's the same mentality behind a wedge. You want to buy the lows, sell the highs. Same idea where you get opportunities on both sides. So when you get up to the highs, sell them. When you get down to the lows, you can buy them. And it's a way that gives you an opportunity to trade both sides of the market while also technically staying with the trend, since the trend is nowhere. So that's going to be market structures. If you have any questions about it, feel free to send an email to School of Trade. Be sure to get back to you as soon as we can. Have a good one. Bye.